Let's be crystal clear. Investing is not about getting rich quick, it's about building lasting wealth over time. It's about making smart decisions with your money, not chasing the latest hot stock tip. In the world of investing, knowledge is power. And that's where The Intelligent Investor comes in. This book, written by the legendary Benjamin Graham, is your roadmap to financial success. It's a beacon of wisdom in a sea of get-rich-quick schemes. It's a must-read for anyone who wants to take control of their financial future. Think of it this way. Would you rather gamble your hard-earned money at a casino or invest it in a well-established business? That's the difference between speculating and intelligent investing. One is based on luck, the other on careful analysis and a long-term perspective. So, if you're ready to ditch the gambling mentality and embrace the principles of intelligent investing, buckle up. We're about to embark on a journey that will empower you to make informed financial decisions and build a brighter financial future. Benjamin Graham wasn't just another Wall Street guru, he was a financial pioneer who revolutionized the way we think about investing. His book, The Intelligent Investor, has become a timeless classic, influencing generations of successful investors, including the Oracle of Omaha himself, Warren Buffett. Graham's investment philosophy is rooted in the concept of value investing. This approach focuses on identifying undervalued companies, businesses that are trading for less than their intrinsic worth. Think of it like finding a hidden gem at a flea market, a valuable asset being overlooked by the masses. But how do you find these hidden gems? That's where Graham's teachings come in. He provides a framework for analyzing a company's financial health, looking beyond the stock price to understand its true value. By understanding a company's fundamentals, its earnings, assets, and debts, you can make more informed investment decisions. You can separate the hype from reality and identify companies with the potential for long-term growth. Now let's dive into the nitty-gritty of value investing. How do you actually find these undervalued companies that Graham talks about? It's all about looking beyond the surface and understanding a company's intrinsic value. Think of it like this. Imagine you're buying a house. You wouldn't just look at the asking price, would you? You'd consider the location, the size, the condition, and compare it to similar houses in the area. You'd want to make sure you're getting a good deal, right? The same principle applies to investing. Don't just look at a company's stock price, dig deeper. Analyze their financial statements, understand their business model, and assess their management team. Look for companies with a strong track record of profitability, low debt levels, and a competitive advantage in their industry. These are all signs of a healthy business that's likely to be undervalued by the market. Remember, investing is not about chasing the latest trends. It's about finding solid companies with strong fundamentals that are poised for long-term growth. Section 4. The margin of safety, your financial safety net. Imagine you're building a bridge. You wouldn't just design it to hold the expected weight, would you? You'd add a safety margin, making it much stronger to withstand unforeseen circumstances. That's exactly what the margin of safety is in investing. Graham emphasizes the importance of buying stocks at a significant discount to their intrinsic value. This discount acts as your safety net, protecting you from potential losses if your analysis proves to be inaccurate or if unexpected events occur. The larger the margin of safety, the lower your risk. It's like buying a dollar for 50 cents. Even if your assessment of the dollar's worth is slightly off, you're still making a profit. Remember, investing is not an exact science. There's always an element of uncertainty. The margin of safety helps you navigate this uncertainty by providing a buffer against potential mistakes or unforeseen events. Section 5. Mr. Market's mood swings. Don't be fooled by the hype. Imagine a person named Mr. Market. Every day, he comes to your door, offering to buy or sell stocks at a certain price. The catch? Mr. Market is incredibly emotional and unpredictable. Some days he's euphoric, driving prices sky high. Other days he's pessimistic, sending prices plummeting. Graham uses this analogy to illustrate the irrationality of the stock market. Prices can fluctuate wildly in the short term, driven by fear, greed, and speculation. However, in the long run, the market tends to reflect a company's true value. The key takeaway? Don't get swept up in Mr. Market's mood swings. Don't let his emotions dictate your investment decisions. Focus on the fundamentals, the intrinsic value of the businesses you're invested in. When Mr. Market is overly pessimistic, offering you bargains, take advantage. When he's overly optimistic, driving prices above their worth, consider selling. Remember, you don't have to participate in every market fluctuation. Section 6, Defensive versus Enterprising, choosing your investment style. Not all investors are created equal. Some prefer a hands-off approach, seeking stability and steady growth. Others are more active, willing to take on higher risk for the potential of higher returns. Graham recognizes this diversity and outlines two main investment styles: defensive and enterprising. The defensive investor prioritizes safety and capital preservation. They typically invest in well-established, blue-chip companies with a long history of profitability and dividend payments. The enterprising investor, on the other hand, is more hands-on and willing to dig deeper to uncover undervalued opportunities. They might invest in smaller companies with higher growth potential, but also higher risk. Which style is right for you? It depends on your risk tolerance, time horizon, and financial goals. If you're risk-averse and seeking long-term stability, the defensive approach might be a good fit. If you're more comfortable with risk and seeking higher returns, the enterprising approach might be more suitable. Remember, there's no right or wrong answer. The key is to choose an investment style that aligns with your individual circumstances and goals. Section 7, Patience pays off. Keeping your emotions in check. Investing is a marathon, not a sprint. It requires patience, discipline, and the ability to control your emotions. Remember Mr. Market? He thrives on fear and greed. Don't let him get the best of you. When the market takes a downturn, it's easy to panic and sell your investments at a loss. But remember, short-term fluctuations are normal. Don't make impulsive decisions based on fear. Stick to your investment plan and ride out the volatility. Similarly, when the market is soaring, it's tempting to chase returns and jump on the bandwagon. But remember, what goes up must come down. Don't let greed cloud your judgment. Stick to your investment principles and avoid making rash decisions. Successful investing requires a long-term perspective. It's not about timing the market, it's about time in the market. Be patient, stay disciplined, and let your investments compound over time. Do you like to read this book? You can read any book of your choice by messaging using the WhatsApp group link given in our description.